You do have tech. Thank you, NVIDIA. Consumer discretionary as well. At the bottom, what's not doing too hot today, utilities, consumer staples, and energy, but small moves overall, Matt Miller.
Yeah, still so much news in this market that you can't take your eyes off it. Coming up, SpaceX is raising money and selling shares at a nearly $500 billion valuation, according to sources that have talked to us here at Bloomberg. We'll discuss that with the reporter who broke the story next. And in the next hour, we speak with Goldman Sachs Chief U.S. Equity Strategist David Kostin. He'll join us right before we get a chance to speak with the White House Council of Economic Advisors Chairman Stephen Miron. So a ton of news today and a ton of amazing guests that you don't want to miss. Keep it dialed in right here on Bloomberg Television.
Welcome back to Open Interest. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, Wynn Resorts getting a downgrade over at Citi. The analyst says that he sees Wynn giving up gaming market share in Macau in the near term. Shares down slightly. Next up, we have T-Mobile getting a cut to a sell over at KeyBank. The analyst over there saying that the stock's underperformance will continue and that its premium valuation is still too high. And finally, we have Microsoft getting upgraded to a buy over at Oppenheimer thanks to AI upside. The analyst says that investors should embrace Microsoft as one of the long-term AI winners in software, Matt, and shares are up about 1.4%.
All right, let's talk about those people who are investing in this technology. Executives have descended on the Allen and Company conference in Sun Valley, Idaho. They include OpenAI CEO Sam Altman. He spoke with a gaggle of reporters about explosive growth in AI and tech.
I am a believer in technology and science and economic growth, and I think that I'm all for offering great services, and I'm all for figuring out ways to make capitalism super inclusive. But I think part of the thing has got to be we drive the country towards very significant economic growth.
The more I see those glasses, the more I want my own pair. Altman spoke after a Bloomberg scoop that SpaceX is discussing plans to raise money and sell insider shares in a deal that would value the company at $400 billion. That would make it the most valuable startup in the world. Bloomberg Tech co-host Ed Ludlow broke that story. He joins us now from Sun Valley. So first, on the SpaceX sale, give us the details, Ed.
Sure. Yeah, it's a mechanism that they've used historically, which is concurrently a very small primary, selling a small amount of fresh equity to set price and therefore valuation. But the main thing is the tender, secondary, right? Give employees liquidity, allow early investors to have some liquidity as well. And it's a big moment. There's been a lot of tension between Elon Musk and the president. SpaceX has great regulatory exposure as well as a lot of business exposure to United States government and various defense apparatus, but it shows continued growth both on the launch business and on Starlink as well.
I do just want to quickly mention NVIDIA. We were talking about it last block. Its rise continues, and it actually now becomes the first company to reach $4 trillion in market cap. So NVIDIA ascendant this morning, and really for the past couple of years, we'll continue to keep an eye on that. But when it comes to SpaceX, part of this rise in valuation, Ed, comes back to Starlink. So talk to us a little bit about what the state of play is there, because that has also come under scrutiny.
Yeah, I mean, over time, the proportion has shifted, right? Starlink becomes more than 50% of revenue. It's higher margin business. You know, the business of sending rockets into orbit, regardless of the payload, is never going to be a big cash cow. And SpaceX increasingly facing competition, Project Kuiper from Amazon, but that's where there's a lot of hope. You know, SpaceX, like many of Elon Musk's companies, it's so hard to get into. You have the biggest private growth equity names, largest venture capital firms, other technology companies, Elon Musk's close confidants and friends, other sovereigns. But the hope is that in the longer term, the Starlink bit will be spun off. There'll be either some kind of listing or opportunity for a broader investor base to participate. And that's part of the story here around the valuation too.
Ed, I can't look away from NVIDIA here. I mean, more than $4 trillion in market cap. I will never forget when you were on air and Apple crossed the $3 trillion mark. I have that phrase ringing in my ears all the time when I think about this climb in the value of artificial intelligence companies. And in a sense, they've left Apple in the dust, right? I know we use Apple devices for the OpenAI app, but Apple hasn't made any moves, really any big moves here. Dan Ives was out with a note this morning saying they should buy Perplexity. What's your thought?
I saw that. Yeah, I mean, what's so astonishing is that Jensen Huang's not here, right, in Sun Valley, but all of his biggest customers are. Andy Jassy's of AWS, Sam Altman, Satya Nadella, not just a customer, but obviously an investor and partner. And what they all have in common is that they've made continued commitments to not just big picture expand data center capacity, but NVIDIA has this commitment to bring out a new generation of GPU annually. And so you have two things happening: a broader expansion of capacity, where NVIDIA holds a monopoly, more than 70% of the market, but also a refresh, a technology cycle that's gone from being multi-year to annual, which is astonishing. And people rely on that technology as a bedrock of what's happening. On the Perplexity thing, it's not a deal that I've been hearing about here at Sun Valley, but it's been talked about for a little while. We had Perplexity's chief business officer on the show last week, I believe, and we asked him point blank, and he wouldn't comment, but said, you know, he wouldn't be doing his job if he wasn't talking to everyone. The ecosystem on the operating system side is really changing, but NVIDIA 4 trillion. Yeah, cool moment. It's weird not to be in the studio for it. But you guys did it. Congrats.
You're in front of a mountain, which is also pretty good. NVIDIA shares up about 2.5% right now, eclipsing $4 trillion. And we had Ed Ludlow right here with us. You can catch more of Bloomberg Tech co-host Ed Ludlow at 11 a.m. Wall Street time right here on Bloomberg TV. And we didn't even get to this meeting that could be happening between Sam Altman and Mark Zuckerberg. I know we talked a little bit about it, but not enough. We've been having so much fun with this story.
Yeah, I mean, it will be interesting, unlikely in front of cameras, right? So we're not going to see that meeting. No. And also, who knows if they're going to talk to each other in an amicable way?
That's
Are they going to be angry with each other?
Fisticuffs, perhaps?
I doubt that is going to happen.
I don't think so either. It would be nice if we could get an official readout, like they were presidents of a country, but we'll continue to follow that story. And up next, we're going to talk about airplanes because Boeing hits an 18-month high for jet deliveries. More on Boeing shares and the other airlines, or rather the airlines in general, next. This is Open Interest. Well, U.S. plane maker Boeing delivered 70 aircrafts in June, and that is the most in 18 months thanks to renewed U.S. jet exports to China. For more analysis on Boeing and the overall airline sector ahead of earnings, we're joined by Savvy Sith. She is Managing Director for Airlines over at Raymond James. It's great to have you with us. Let's start with Boeing because there's obviously a lot underway when it comes to Boeing and their turnaround efforts, but there's also an element of trade policy here, and it seems like for now those winds are blowing in Boeing's favor.
Thanks for having me, Katie. You're exactly right. It's it's great to see Boeing kind of turning around things and really showing improvement here in 2025. There is a lot of kind of uncertainty around the tariffs, and where components are made, and hopefully we'll kind of stick to the policy that was there before, which is that kind of global aviation supply is kind of tariff-free. But from an airline perspective, what we've been hearing is kind of Boeing has been delivering on time relative to new schedules and sometimes even faster, which is encouraging after several years of delays and mishaps. So, overall, a good setup here.
If, the airlines that you cover, Savi, for example, Delta, which announces earnings tomorrow, they use Boeing. They're never going to switch over to Airbus, or have they been doing that?
Thanks. Yeah, if you look at Delta, they fly both operate both Boeing and Airbus aircraft. So the largest carriers, American, Delta, and United, they fly both types. Southwest is another big carrier in the U.S. They're solely Boeing. So, it's in their interest to kind of see a successful Boeing, but also have a kind of a tariff-free environment overall.
And focusing more specifically, of course, on the airlines, we got Delta kicking us off tomorrow. It just feels like demand hasn't been there. It hasn't returned to really robust levels. Occasionally, we get these bursts of optimism and you see shares pop, and then we go right back to this sort of sideways chop that we've had for the past couple of years. Are you expecting something different here, or maybe more of the same?
Right now, we're seeing just more of the same, unfortunately, Katie, because, if you look at, you're quite right. You're seeing some, green shoots that maybe we'll see demand at least progressing closer to where it was at the end of last year, early this year. But then some headlines will hit and you'll see a reversal again. What we'd be looking for, at least post-summer is there a change in corporate travel behavior? If we have more clarity around government spending, how stimulus is working, how tariffs end up, is there more comfort or certainty in for some of that corporate travel to come back? So that's what we'll be looking for. But right now, there's no change that we can discern.
All right, Savi, great having you on the program. Thanks for joining us. Savi Sithere of Raymond James talking to us about airlines after Boeing deliveries came out, and tomorrow we get earnings from Delta. Now, NVIDIA is really in our focus. It is the first ever $4 trillion company. You're here for an historic moment as the company crosses over that $4 trillion mark. It is, of course, the most valuable company in the entire world, and we're going to continue to focus on it. Coming up in the next hour, Goldman Sachs Chief U.S. Equity Strategist joins us, David Costin, as well as White House Council of Economic Advisors Chair Stephen Myron. We are 30 minutes into the trading day. You can see markets are up across the board with the S&P 500 at 62.65. This is Open Interest. I'm Matt Miller.
And I'm Shanali Basak. We have a lot going on in this show. And of course, we're going to hear from Wall Street. We're going to hear from the administration. We're going to make sense of it all for you.
Yeah, there's an absolute ton of news. So many single stock stories and so many stories in your wheelhouse about hedge funds and private equity. So
deals.
Yes.
Anyways, coming up, President Trump escalates his trade rhetoric and threatens more tariffs on copper and pharmaceuticals.
From Merck's $10 billion bid to Meta's bet on AI glasses, that's $3.5 billion. We've got a roundup of today's big deals.
And pledging loyalty. Goldman Sachs plans to ask junior bankers to confirm every 3 months that they have not accepted jobs elsewhere.
We begin, though, with trade tensions. President Trump now says he will push forward with his tariff regime, and there will be no more extensions, just one day after hinting that his August 1st deadline wasn't so firm. The president turned his attention then to two very specific industries.
I believe the tariff on copper, we're going to make it 50%. We'll be announcing something very soon on pharmaceuticals. We're going to give people about a year and a half to come in, and after that, they're going to be tariffed if they have to bring the pharmaceuticals into the country, the drugs and other things into the country. They're going to be tariffed at a very, very high rate, like 200%.
Let's get the state of play from Bloomberg's Washington correspondent Tyler Kendall. So, Tyler, on the one hand, it looks like the August 1st deadline will be fairly firm for countries, and then the industry-specific tariffs or product-specific tariffs will be less so.
Yeah. Hey, Matt. And it's interesting because these two different tariffs, they are enacted under different provisions, but they've really become intertwined in the negotiations that we're seeing moving forward here when it does come to these expected tariff letters that could be coming more later today. President Trump had previewed that there could be 2 waves of letters today, with a minimum of 7 countries receiving them this morning, and then a second batch coming in the afternoon, as he doubles down that this really is the last chance for these countries to negotiate. The president had told reporters yesterday that we could expect some of these levies to reach up to 60 or 70%. He didn't give specifics beyond that, but of course that would be significantly higher than some of the marginal differences that we've seen so far outlined in these letters compared to the April 2nd rates. Interesting enough, he told us that one of the trading partners to look out for a letter here is the European Union. And that brings us back to the top of the discussion about the sector-specific tariffs, because it's our understanding that they are nearing a technical agreement in principle, but that the European Union is trying to find those exemptions and carve-outs when it comes to sector-specific tariffs, like autos, for example. But as this threat really does ramp up about the future of copper and pharmaceutical tariffs, that's just going to complicate the negotiations further as our trading partners rush to get a deal done by that August 1st deadline.
Tyler, we thank you so very much for keeping an eye on all of it for us. That is Bloomberg's Tyler Kendall. We're now going to bring in David Kostin. He's Goldman Sachs' chief U.S. equity strategist on the latest price target increase for the S&P 500. Because, of course, David, really interesting here. This is by far not the first time you've done this year. At what point do tariffs become problematic for you?
Well, the idea of tariffs are baked into our forecast right now. We're looking for earnings growth this year of around 7% and earnings growth in 2026 also of around 7%. And investors are now starting to turn their attention into next year's earnings. I know we're only early part of July of 2025, but the investment analysis looks into next year and discounts that back. So the idea of tariffs, we're assuming somewhere in the mid-teens, likely to be the final level. The effective rate for tariffs last year, as you know, was around 3%. It's already up into low double digits right now, but the real insight will probably be later this year when we'll have sort of a run rate level of tariffs. But from our perspective, the market investors are sort of thinking about the mid-level of mid-teens, and that's probably what's going to support an earnings growth of 7%, and that's why the market moves higher.
Companies seem to have, Nir Kesar wrote for us at Bloomberg Opinion, really fat margins right now, so they can absorb to some extent these tariffs.
I want to think about it the following way. In the last 30 years, margins have gone from 5% to 12%. That's net margins for the S&P 500, 5 to 12. What are the driving factors of that? What are the building blocks? Lower cost of goods sold, lower COGS, about 5 percentage points of that improvement in margins comes from there. Lower tax rates, another reason. Lower interest expense. Those are the reasons why margins have moved higher. And so we look out in the next couple of years, tariffs are a way of increasing the cost of goods sold. That's a downward pressure, likely to be a downward pressure on margins. Some of the debt that's rolling over for some companies is actually rolling over to a higher level. And so, Matt, the way you want to think about this is the tariffs are a downward pressure. And then who is going to pay for those tariffs? Is that going to be the suppliers? Is that going to be the consumer? Who's going to pay for that?
All right, David, you stick with us here. I want to now bring in our Bloomberg TV and radio audiences worldwide. We're going to simulcast this. Joining us now is White House Council of Economic Advisors Chairman Stephen Myron. Stephen, thanks very much for joining us. We were just listening to David Kostin of Goldman Sachs giving an optimistic view of the stock market and the way companies are dealing with tariffs. And I wonder how you think about the uncertainty that this creates. You definitely must have calculated that in coming up with this strategy. And if we're going to see an end to that uncertainty come August 1st.
Good morning. Thanks for having me. Look, I do see the uncertainty starting to reduce in the near term. Part of the benefit of uncertainty is it gives us leverage in negotiations, right? Like the president knows how to extract concessions from our trading partners, and he has been very successfully doing so. Now, as what you've seen with a number of these letters is there's some countries that haven't made the concessions that the United States requires, and as a result of the decades of accumulated trade deficits, the president has decided that tariff rates should ratchet back up for those countries on effective August 1st, and I expect that to happen.
I want to talk more about the sectoral tariffs, the Section 232. You look at copper just over the last 24 hours and the price increase you've seen in copper alone. This is a critical input for data centers, for power grids, for industrial machinery. And as the administration looks to bring more manufacturing onshore, how isn't it the case that a 50% tariff would impact some of those other efforts to otherwise power the economy?
So you have to differentiate between changes in relative prices and changes in the general price level. And when you target a specific good with a tariff like copper or some other specific good, you're going to get relative price changes, and that's totally expected. But that doesn't mean that there's an increase in the general price level, by which we mean inflation, because there are lots of thousands of products and services that go into the general price level, and it's an average, a weighted average across all of those. And we just published research yesterday showing that there has been no tariff-induced inflation in a general price level since the tariffs began being implemented in January. Quite to the contrary of all of the Cassandras that were shouting that it was going to be extremely inflationary. There's just no evidence of that thus far. Just
Stephen,
like in 2018, 2019. Yeah.
Listen, I read the research, and we'll get back to it. But on copper, I want to read this note from Jefferies. They say that the U.S. does not have nearly enough mine smelter refinery capacity to be self-sufficient in copper. So then, why target it?
Well, we need more of it. We need more of it produced domestically. There are certain critical minerals, of which copper is one, that you just absolutely need if you're going to have a manufacturing sector. And having a manufacturing sector is important, not just economically, because it tends to be a high capital, high productivity field with good paying jobs, but also for national security. You cannot defend yourselves if you do not have a robust manufacturing sector, and critical minerals like copper are essential to that. So will we be able to corner a market in copper? Absolutely not. But can we make more than we currently do? Yes.
So how long will that take? I mean, for example, when will these copper tariffs go into effect? Or is this just a stick rather than a carrot that you use to try and motivate the industry?
No, well, the president said we're going to do copper tariffs, and I think the president, and I think the president follows through on his promises. So I would expect them to happen. I don't have a date for that happening. Yeah. Well, I don't have a date for that happening. That process is underway.
All right. I want to ask also about the first point that you made, using tariffs not necessarily as a revenue raiser, but as leverage in discussions. I've watched Japan tariff U.S. automakers for decades now, and they refuse to back down. Are you going to be able to extract that kind of concession from such a stubborn economy?
Look, I think that the president is one of the best negotiators in history. I mean, he's spent decades negotiating deals across every field, from commercial real estate to international trade, and I have no doubt that he can negotiate successfully now too. But in order to negotiate successfully, other countries have to know that you're serious and that you're willing to do what it takes to get there, and that's what these letters show, that we are absolutely serious. So I hope that a country like Japan comes to its senses and does make the concessions they need, because it'll be better for them if they do.
Stephen, I do want to go back to your report, and I do appreciate the reports that have been coming out of the Council of Economic Advisors. I have been reading all of it. On the most recent report on the imported goods inflation, what do you say to the people that are looking at the impact of energy prices? Because if you subtract petroleum, you're not getting the same impact. In fact, you're seeing the price of goods rising in many categories that matter to American households, like electrical equipment and appliances.
Yeah, so you're right to flag that energy prices have come down and that we got to the lowest price at the pump since 2021, I think. And that's been a huge advantage to American consumers and a huge advantage to the American economy. It does drive the overall, some of the overall indices in the inflation data. But even if you take energy out and you look at core goods, as we do in our paper, or at durables, you still see the same wedge. No matter how you slice the different goods data in the inflation data, there's a consistent roughly 50 to 60 basis point wedge between the price increases in domestically produced, in overall goods versus the price increases in imported goods alone. And when you annualize that 50 basis point wedge, obviously it comes to a bit more than a percentage point at an annualized rate. And so when you slice things like taking out energy or just looking at durables or whatever, you end up with different levels, but the wedge between overall goods and imported goods remains. So the conclusion continues to hold.
So I also want to ask about the central bank here. The president himself has been very, very vocal for the desire for lower rates. He has said just recently on Truth Social that 3 points is too high, and he's talking about the interest costs that are embedded with higher interest rates, which of course is a good point when you do have interest costs about to reach $1 trillion or more pretty soon. But at the same time, he has been very critical of the Fed. I want to read you this note from Neil Dutta over at Renaissance Macro. He's basically saying here that the pressure that the president is putting on the Fed is making it so that any future nominee has to be beholden to what the president is saying. What Neil Dutta said is Trump has created a litmus test for his Fed nominee. They have to agree to cut rates. If Trump picks someone close to his orbit, that person will look like a complete toady, and I'm quoting the research, and have a limited ability to persuade colleagues to a dovish position. At some point here, is the president's weighing in on central bank policy counterproductive for what should otherwise have been an independent central bank?
Thanks. So, look, I'm a huge fan of Neil, and I get along great, but I don't agree on this point. I don't think that at the end of the day anything matters but what the policy rate is. I think, sort of sitting around talking about, about optics and committee, sort of internal committee discussions doesn't really matter. What matters is what the policy rate is and what markets expect the policy rate to be. And if they expect the policy rate to be better for the economy, then we'll have better economic outcomes, and markets will welcome that. If the policy rate is set in a way that's not better for the economy, then we'll have worse economic outcomes, and markets will reflect that. I think the rest of it is just chatter. What matters is policy being set well, or is it being set poorly?
Stephen, can I ask about just the basics of raising revenue? What do you expect from tariff revenue, say, over the next 3 or 4 years, since that's what's left in this term? And what about golden visa revenue? I heard Howard Lutnick saying that you've got 75,000 applicants or queries, and at $5 million apiece, that would be like $375 billion, massive amounts of revenue. If you could, can you repeat that every year and bring in like at least $250 billion in revenue every year from selling visas?
Thanks. So I expect the tariff revenue to be substantial. And in the research we put out about the deficit implications of the One Big Beautiful Bill and the rest of the administration's policies, tariff revenue played a substantial role in thinking about where the deficit would go in future years. We had about $3 trillion over a decade from it, which works out to obviously about $300 billion a year. And that's pretty close to where CBO ended up to when CBO got around to scoring it. So that's a number that I think is a reasonable baseline expectation. Given tariff rates are going a little bit higher now, the number might actually be a bit higher than that. So, I think it's such a fantastic thing to raise money from tariffs that are ultimately, the incidence of which is ultimately borne by the tariffed country, and use that money to finance lower marginal rates in American families and American firms to encourage more investment and more work here and encourage reshoring. I think that's just a fantastic common sense policy combination. With respect to the golden visas, I mean, look, I think that Howard has enormous demand for these things. He's created an amazing product. Howard and the president have created an amazing product that has attracted enormous amounts of interest from foreigners abroad, and I think we're going to see that huge demand materialize. However, I think you're right to point out, I don't expect that demand to reproduce every single year. It's not going to replicate every single year. I think you'll see a big demand up front.
All right. Really interesting stuff, Stephen. Appreciate your time. White House Council of Economic Advisors Chairman Stephen Miron. Now we are back here with David Kostin, Goldman Sachs Chief U.S. Equity Strategist. I love the golden visas revenue idea, right? It's just so tantalizing to imagine getting $350 billion a year, but, maybe that doesn't hold up. What do you think about the effects of one big, beautiful bill? Now that we have it, and Stephen was obviously a huge part of creating that legislation, now that we have that certainty, and now that investors can calculate, put it into their models, is it a good thing?
Well, I think the clarity, as you just referenced, is really the important thing for portfolio managers and for corporations. Corporate executives thinking about capital spending decisions, dividend policies, things like that, all are enhanced when they have some clarity on what the policies are likely to be. So in that regard, the fact that it was passed means we can look forward and see what are some of the fundamentals. And the idea the economy is decelerating but still growing is an important backdrop. And the idea that the Fed is likely to be cutting interest rates 3 times, the Goldman Sachs economics forecast, 3 times starting in September, twice next year. That is an environment where bond yields are likely to also be lower. 10-year Treasury yields probably around the 4.2%, and that supports our forecast of around 22 times multiple for the S&P 500. So that valuation, which is current today, we think forward earnings growth 7%, that lifts the S&P 500 in our view to 6,600 by the end of this year, 6,900, 6,900 by middle of 2026 or next 12 months. That's the general backdrop. Again, the clarity on policy is important, and now investors have moved beyond sort of this year, really beyond the tariff discussions. The view is it'll be eventually resolved, and what's the general thrust of business?
You could make an argument that some of the market has already been looking beyond some of the current policies, trying to feel the impact of deregulation, lighter regulation. KBW Bank Index now up more than 12%. It's almost Super Bowl, right, aka bank earnings next week. And so that'll kick off. This earnings season will be really interesting to watch. Every single bank except one in the KBW Bank Index is up on the year. Have we seen the best it's going to get?
I think one important aspect to think about, we've had an incredible 25% rally in the last 90 days. A 25% rally in the S&P 500. It is a really, really narrow breadth market. It's really led by some of the largest companies in the market. That's fine, but the idea of the median stock, the typical company, is down 11% lower than its 52-week high. If you look at the mid-cap stocks, you look at the Russell 2000, these stocks are down basically 10%, or they're trading 10% lower than their 52-week high. As a consequence of that, the idea of some opportunities in these other sectors are where we are focusing our discussions with portfolio managers. The alternative within the financial sector, banks have had a terrific rally, as you just referenced, a lot of dividend increases once the CCAR results came out. And so what are some of the areas within the financial community that have lagged relative to our model? And the alternative asset managers are certainly one category that we focus on.
What do you think about the Fed path? As you pointed out, people are already looking to 2026, right? And at that point, President Trump is going to be able to put very likely a yes man, right? Someone who wants to cut rates dramatically in the chair. Do you expect that person to be able to push those cuts through? I mean, are you looking at 3 percentage points cut in 2026?
Well, what matters more for the stock market is real interest rates, real 10-year bond yields. So you think of nominal yields, we're looking at something in the vicinity of 4.25%, which is supportive of a valuation, as I indicated, around 22 times forward multiple. And that is the area that investors in the equity market are probably more focused on than specifically the path of the Fed policy. Now, our baseline forecast is you're going to get because inflation is going to come lower, the economy is going to still grow, and the Fed has that capacity to be lowering rates. So that's the general path that we're anticipating, and that supports the market generally moving in a positive direction at this juncture.
So I'm going to ask our producers to pull up a chart, #BTV4400. This is a Bloomberg Intelligence analysis of the top 20 or so firms that have benefited the most from tariffs and the bottom most impacted, like the worst performers, the ones that are most impacted by tariffs. The divergence is real. There has been a bounce back from the bottom of April. However, the best performers have been up almost 20%. The worst performers are still down almost 5%. How does Goldman think about this in baskets? What does well, and do the ones that have not performed well, do they continue to lag into next year?
Well, the idea of margins is at the core of investor discussions right now that we have, which is who is going to pay for those margins? Is that going to be the supplier? Is that going to be the corporation absorbing them? Is that going to be the consumer at the end of the day paying for that? And historically speaking, it's the consumer that ends up absorbing much of that cost. And now a lot of companies advanced their inventory at the beginning, so that makes the analysis a little bit more complicated. When you look at the share prices that you just showed in your graph, that could be complicated by the idea of this is how the share prices are performing. What about the fundamentals? And we're going to kick off next week on the 15th of July with all the bank earnings. And the next six weeks or so, we'll have much more clarity in the question of how is it that companies are dealing with these tariffs. And remember, the tariffs only partially were applied during the second quarter. So the second quarter still is uncertain. Now it's been pushed out in many cases really until maybe perhaps August 1st. So there's still a transition process here. But in terms of those stocks, there's certainly a lot of questions as to who's going to pay for the tariffs. And our view generally is the consumer. It's going to be ultimately passed on to the consumer. You
were here for an historic event, David. NVIDIA passed $4 trillion in market cap. We've fallen back a little bit below that, but we're there. And we've seen this company and this industry power the U.S. stock market higher for 3 years now in a row. How much more room is left for this gold rush to continue? I mean, where do you think we are if you were to compare AI opportunity to a baseball game? In what inning are we right now?
Well, let's think about that in baseball game. There's sort of phases of that. We think about phase 1, 2, 3, and 4. NVIDIA is absolutely in phase 1. We'll call that, the early innings that are necessary in order to build out the infrastructure. That's the leading edge of the infrastructure. But then you have the utility companies, you have other semiconductor companies, you have some of the hardware companies. That's sort of the second phase on the infrastructure. Now, where we are, I would say, is we're 2.5 years. November of 2022 is when ChatGPT was introduced. We're 2.5 years in. We'll say perhaps that whole transition process is maybe 5 years. So we're sort of halfway. So first, to answer your question, maybe we're halfway through one scenario. And so you've gone from the leading edge, NVIDIA, you've had the infrastructure, now you have the applications. And most companies, when we talk to most companies and ask how is it that they're using AI, they're still looking for getting their data codified in a way that can allow the AI, generative AI, perhaps to make them more efficient. So that's the third phase. And the fourth phase is what's the long-term implications for corporates. And so another way of sort of summarizing this is the transmission mechanism for AI through the margin channel, better margins, more efficiency, or is it through the revenue channel? Is that companies can boost their output and get better sales? Mm-hmm. There are different companies that are going to benefit or be different ways in which they can benefit. And so this is one of the things that I find most surprising is that only half the companies in the S&P 500 chose to discuss AI on their quarterly conference calls. Only half. The other half chose to, we're mute on the subject.
David, we got to leave it there. We're hitting a hard break. That is David Kostin of Goldman Sachs. Know you're on the road a lot, so appreciate you joining us here in studio. Stick with us. Markets still near session highs of the day. This is Bloomberg.
Let's get a check on the stock market right now using the move screen. I think this is the most dynamic way to look at an index, in this case the S&P. You can see we're off our session highs now, but still up on the day with the breadth about 3-2. 283 stocks rising, 218 are falling. NVIDIA adding the most points right now, almost 10 points with a 2% gain. It eclipsed a $4 trillion market cap, but has now under that a little bit. I'm going to take a look now at the sectors. You can see communication services. These are the hyperscalers as well as IT. These are the biggest gainers as we watch the Allen & Co. conference in Sun Valley, Idaho. Coming up, President Trump upending the global copper market. We'll take a look at that with John Wobensmith of Genco. President Donald Trump sending the copper market into turmoil. He announced a 50% tariff on copper imports, which immediately caused a record spike in New York futures and a drop in the global benchmark. This is the intraday trade today. It would have looked very differently yesterday. Companies across the world are racing to get copper aboard ships before the tariffs kick in. Joining us now is someone who owns a lot of those ships. John Wobensmith is the CEO of Genco. They own 42 dry bulk vessels around the world. And John, we were just talking, you have ships that bring back in one fell swoop 55,000 metric tons of copper from Chile. Are those in strong demand right now?
Copper in general is in strong demand, and yeah, there's about 1 million tons that are imported a year from Chile into the U.S. And I will say it is a little it was a little surprising to see a tariff put on copper, but when you start to think about it a little bit more, 25% of what the U.S. uses is actually produced here. And there is a brand new mine that is sponsored by Rio Tinto in Arizona that just got regulatory approval. So you have to wonder if there's some other pieces being moved around here.
That is interesting, but you look at also the amount that we import. You mentioned Chile. The other place that Chile exports a lot to is to China.
Yes.
How do these routes change? How does the equation for trade change if the U.S. is putting a 50% tariff on copper imports and China is not?
Yeah, so China is really interesting. They clearly, as you said, they import from China or from Chile, but they also have mining projects, particularly in the Congo, that are copper focused. So there are alternative sources for China, and it's one of the things China has been doing over the last 5 years in particular, and that is investing in other mining projects, particularly in West Africa, bauxite, iron ore, and then the copper that I mentioned in the Congo.
These tariffs, both the country tariffs and sectoral tariffs, have they been great for your business because of people pulling demand forward?
There's definitely been demand forward on soybeans, particularly out of Brazil. And we all know that the Chinese have gotten very close with Brazil, going both ways, but soybeans in particular. And so what we've seen is U.S. soybeans down 35% for this time of year. Now, we are not in peak season. Peak season really starts in September, and so that will tell the tale. But I do find it interesting, the last trade negotiations during the previous Trump administration, when they settled with China, they had tons of soybeans and ag products that needed to be moved out of the U.S. That didn't happen in this negotiation. As you know, it was more about rare earths than actual agriculture. So remains to be seen.
You tend to see things before the broader American public does, just the way that things are being brought into the country. Now, where else are you seeing that front loading? Where do you begin to get worried about inflation, if at all, with certain types of goods?
And where are things slowing down?
Yeah, so it's interesting. Not our business, but we obviously follow a lot within shipping. And if you look at the container rates, there was a lot of front loading into the U.S., China into the U.S. So those rates were, moved up quite a bit several months ago. The opposite is happening now. So container rates, China to the U.S. have actually dropped, but they've increased in Europe. Some of that has to do with the Red Sea hostilities again, but it's also because of a lot of the front loading that happened and the scarcity of tonnage available to go to Europe.
We were talking during the break about what's going on in the Red Sea, and there's a lot of very bad stuff happening there. Crews kidnapped and essentially terrorism, right? You're avoiding that by going around. So what does that add to a shipment in terms of cost? Obviously, it's worth it in terms of safety, but...
Yeah, look, it probably adds 10 days, and we build it into our freight model and our freight pricing. It's very upsetting what's happening now, because I think a lot of people felt that tensions were cooling down. That we haven't put our ships through there since December of 23. That's when we made the decision not to go through there. But there have been 2 very recent attacks on dry bulk vessels. Fortunately, not ours. Again, we're not going through there. But it seems to be getting more lethal and more dangerous, because we're actually now having crew members, unfortunately, being killed. And it's the pride needs to be solved. And
what's the answer to that, John? I mean, we have already launched a ton of attacks on the Houthis, right? Everybody got to read it in the Signal chat.
Yeah.
But it doesn't seem to have solved the problem.
It doesn't. I think we need more military assets actually there and patrolling. We had that situation. We had a global force when there was piracy off the coast of Somalia. Indian, Chinese, U.S., I think we need more of a presence there. Because what the Houthis will tell you is you can go through, just don't call Israel. If you call Israel, then we're going to come after you.
Now, you mentioned you've been not going through the region since 2023, and that just goes to say there's been years of geopolitical conflict. When the broader American public is looking at the news, they're looking at kind of the worst of the worst happening. But realistically, there has been a lot of bad stuff happening for years to the point you've been making. So what is the risk geopolitically moving forward? And perhaps how could that create inflation spikes that are unwanted, right? It wasn't long ago that we were concerned about the closure of the Strait of Hormuz.
For sure. And I think, look, that probability has dropped significantly, which is good news. But that doesn't mean it's necessarily gone away. I mean, we find out, tensions flare, on a weekly basis. So I think that's much lower probability now. But you can't rule it out. The Red Sea situation is definitely adding to freight costs on the container ship side in particular, but also to some degree in our business.
John, it's really great to get such valuable intel from you, and really appreciate your time. John Wobensmith there is the CEO of Genco. Let's get a check right now on what's going on in these markets, because there is so much to talk about, right? In terms of single stock stories, you've got a flurry of deals, you've got potential deals, you've got share sales.
A lot going on under the surface. So yes, today the animal spirits are out to play. Even the 10-year has a little bit of a bid in it. We're going to talk about those deals that have been coming out this morning. We're going to bring in Bloomberg deals reporter Liana Baker, leads the team here in the United States. They've been breaking a lot of news. But talk to us first about perhaps what's going on with Merck. It's a really interesting move that they made with a patent cliff coming around the corner. What did you make of the price?
So there wasn't a huge premium here for a biotech, but it's a company that, for us at least, sort of came out of nowhere. It wasn't worth, this $10 billion valuation just a few months ago. So, but for Merck, this is a big deal. It's their biggest deal in years. They had been sniffing around a lot of assets, so it's exciting to see them finally do something. But you mentioned the patent cliff with Keytruda, their top cancer drug, 2028. A lot of investors are watching that, and apparently this is just going to be a drop in the bucket for Merck. It's only going to bring in $1 billion more of revenue. So while it's a step in the right direction, it's definitely not going to replace Keytruda, and we'll have to see more deal making to fill that gap.
I would mention this is a $10 billion deal for $1 billion in annual revenue for Verona.
Right. One of the stories we haven't talked about a lot today is the Meta investment in EssilorLuxottica. Of course, they already have been using those brands.
Ray-Bans.
What's the story? Ray-Bans, Oakleys?
So not a takeover per se, but definitely interesting to see Meta investing up to more than $3 billion in this company. We did see Google a few months ago invest in Warby Parker, a smaller investment. So all eyes are on this space. It's unclear, the exact terms of this, but it had been in the works, I think, a long time. There have been reports back in 2024 that Meta was looking at this. We're interested in Meta doing all these deals. The Scale deal a few weeks ago was also big, so they really seem focused on the future, and they're trying to invest in different companies to sort of fill out, what's next for them. And Mark Zuckerberg's in Sun Valley, apparently. So.
Maybe more deals where that came from. Also in Sun Valley, Ed Ludlow breaking a scoop overnight with our team. SpaceX inking a new valuation with a planned offering of insider shares being sold, $400 billion. What do you make of that?
I think it's even more, and it's crazy and hard for any deals person or investor to understand these valuations. I know there's a lot of attention on SpaceX, the Starlink satellites. I'm interested to see if they raise a primary round. That was mentioned in the report. That would be new money coming in. But in terms of a SpaceX IPO, what would that be worth? When would that happen? So our team is trying to figure out these sort of longer term.
And do they need it?
Right, with so much insider money, but at some point, some of these valuations, you have to ask: is it sustainable? I know it's Elon Musk, SpaceX is sending these rockets up, sometimes successfully.
We've been asking that question about Tesla for 15 years, Liana. 15 years of that's an insane valuation.
right? But just these eye-popping numbers are definitely keeping us busy and, attracting a lot of eyeballs.
Listen, people don't sell. If you have a SpaceX share today and you're a private wealth investor, people hold on to it very, very closely. Now, if it's in public markets, Liana's point about a $400 billion valuation, could it hold up when you can get in and out as quickly? I think that there's an interesting
Can I just remind you that Tesla's worth $1 trillion? So the answer to your question, could it hold up, is yes.
Could.
100% yes. Right? Because you see that investors are willing to pay almost anything for exposure to Elon Musk, and this is just another way.
It's all in the private markets, though, so it's hard to see, this actually trading hands. I'm sure it's a great report, but it's very different than like a Merck acquisition where we could read, exactly what people are paying for that.
Great to have you on set with us, Liana. Thanks very much. Liana Baker runs our deals team. Coming up, Goldman Sachs has a new plan to help stop private equity firms from stealing its talent. They're going to make you promise, if you work there, that you haven't got a job lined up somewhere else. We're bringing the details next. This is Open Interest.
And I want to now bring you some breaking news. Linda Yaccarino says she is stepping down as the CEO of X. Of course, this has been 2 years that she's been running the company. When she came in, there was a lot of questions on how she would navigate a relationship with the CEO who's known for being very, very involved. And of course, there have been a lot of changes under her tenure. We're going to bring you more in just a little bit as we know it. But of course, a big deal for X, of course, not publicly traded, but very closely tied to the capital markets of late, as this company has been making a lot of moves with bringing on new investors. Now, it's time now for the Wall Street Beat. This is our top story of the day. Goldman Sachs plans to ask junior bankers to swear their loyalty in a bid to thwart poaching by private equity firms. Joining us now for more, broke this story, Bloomberg reporter Todd Gillespie. So we know that private equity firms have been going earlier and earlier to talent. We've heard as early as sophomore year of college. Goldman's used to this, isn't it? And I think you and I have both heard Goldman bankers say it's been a while since we've heard a private equity firm taking some of our talent. So what happened?
Yeah, well, I mean, what we know is that Goldman is now planning for their new analyst class this year to start implementing a rule where now every 3 months they have to, for conflict of interest rules, of course, tell Goldman whether they have already accepted a job offer from elsewhere, whether they've lined up a new opportunity outside the firm, which could potentially present some problems, some headaches. Maybe they're going to be working on a deal for a private equity company that they're about to join, but their bosses don't know that yet. Those are the kinds of headaches that you know these MDs want to avoid. But obviously, they also just want to make sure that they're keeping their best talent. So at the end of the day, this is also a, you know, let's just make sure that you're in your seat for a while.
Why is it such a big deal? I mean, isn't the idea that you go to one of these analyst programs for a couple of years and then you're free to do something else? Does Goldman Sachs really want to hold these people there and develop them?
Right, David Solomon is so excited about his alumni network elsewhere.
David Solomon is very excited about his alumni network. David Solomon does boast of these boomerang hires where people go away and make big bucks in private equity, come back as partners to Goldman Sachs. He likes boasting about that in earnings calls. We all know that. But fundamentally, Matt, you know, they also want the best bankers at Goldman to stay at Goldman, and they want to know that the people they're investing in are going to be there for the long haul, and that they're going to provide the kinds of, you know, the kinds of intelligence, the kinds of networks that Goldman want over the years.
But surely, Todd, there are other ways to do that rather than having somebody swear an oath of allegiance, right? Why don't you just say, here's a pay package that's weighted heavily to later down the road?
Yeah, there are certainly ways of doing that, I'm sure. I mean, I think a lot of, I think a lot of the banks have tried these sorts of moves over the years. There's also a limit to how many people they can promote. Obviously, each year, a lot of these young, up-and-coming talent, they want to get big bucks as fast as they possibly can, and they know that private equity is willing to pay bigger pay packets.
So, want to bring up the meme stock accounts here, because these are the ones that have pushed kind of justice for the junior bankers for the last couple of years. High Yield Harry says these big bad banks are genuinely too scared to talk to sponsors about pushing back recruiting, so they take it out on the 23-year-olds. They have been working 80-plus hours a week. Now, you know, how do you respond to that? Why don't they just, it's true, right? Didn't Apollo just come out with a note very recently about how they were going to stop poaching for the banks and stop pissing them off?
And I mean, that is one thing, but I don't think it's actually just about pissing them off. To be fair, I did speak to one banker a little while ago who told me, just a couple of months ago actually, and they were saying that you know, a lot of their own private equity clients, their sponsor clients, had told the banks, you know, look, we know we've pissed you off for a few years now. We're gonna ease off, partly because the talent we're getting from you actually isn't as good as we want it to be. Actually, it would do us better. It would serve us better if you train them up for just a little bit longer, maybe 3, 4, 5 years before we poach them, just so that you know they've learned all the skills that they need. Because a lot of the young folk that they were getting into these PE firms just weren't at the level that they thought they were at, because they were hiring earlier and earlier and earlier, and these people didn't have the experience, hadn't proven themselves and got those skills that they really needed at PE firms.
Todd, awesome story. Instantly became the most read story on the Bloomberg terminal and has been there ever since in the #1 slot. Of course, everybody wants to read about this. Todd Gillespie covers Goldman Sachs and the banks for us. I want to get back to that breaking news now that the CEO of Twitter, now known as X, Linda Yaccarino, will be stepping down from the company after just 2 years. She said it in a tweet, doesn't give a reason. We bring in Bloomberg's Max Chafkin, who covers all things X and Elon Musk for us. Why do you think she's leaving?
Well, if you've been following the news lately, there have been quite a few reasons, I think, that have pushed Linda Yaccarino away. I should say, first of all, 2 years is a long time in Elon Musk's orbit, especially in the role she was in, kind of serving as a buffer between Elon Musk and the world of advertising. You know, that's going to be very